It is my pleasure to welcome Jeffrey Sherman, Chief Investment Officer of DoubleLine Capital. Jeffrey, great to have you on Forward Guidance.
Yeah, thanks for having me, Jack.
Jeffrey, you are the Chief Investment Officer for a very large fund that invests in mostly fixed income stuff, so bonds, some mortgages, that type of stuff. You also do equities. So I want to pick your brain. There are two sort of principal risks that I think fixed income investors face. That is credit risk and interest rate risk. Now, I could give sort of the textbook definition for our viewers, but how about you give your definition? How do you view these two risks, and which do you think is a greater risk at this point in time?
Yeah, I think you really distilled the fixed income market down to its principal components. I mean, that's really what it is. Whenever you enter into, or you lend someone money, you obviously have to charge them a rate that's commensurate with their creditworthiness, right? But there also just needs to be a base rate of interest as well, which we call the interest rate risk component. There's times where interest rate risk and credit risk are positively correlated, but in a lot of the cycles, they tend to be negatively correlated. And so we've lived in a world really for the last 20 years or so, coming into 2022, where roughly, you've had this really strong negative correlation between the interest rate component and the credit component. And inherently, that makes some sense, right? If you think about, when the economy is doing well, you have a Fed or, interest rate policy should be pushing upward, right? You have growth, you have, potentially some levels of inflation, and that means interest rates potentially should push higher. And in that environment, probably, there's money going around and people are looking for opportunities. And so the credit worthiness, people don't, they think about a good economy, and so they don't require a significant incremental spread for that credit risk. And so that's why spreads tend to be, the spread on credit products tend to be relatively negatively correlated. But there's also inflection points. And I think, what's different about this cycle, and now, I said 20 years going to 2022, but it really should be 20 years going to 2020. Because when interest rates get extremely low, or at least low relative to the levels of inflation, you can have a big repricing of markets. And especially when you have negative interest rates, which we'd seen in Europe for many years now. We had very low interest rates in this country. The 10-year got to this lowest level, kind of ever that we've seen, at least in the modern post-World War II era. And when you come off low levels, the 10-year and in August of 2020 got down to about 50 basis points. And, if you think about the repricing from 50 basis points and you put a credit spread on it, it's like, okay, well, if that's the risk-free rate of money, great. So we put a spread on it. So, corporate bonds should maybe yield 2%, risky corporate bonds should maybe yield 4%. It's that spread to that 50 basis points. However, once you get a repricing, and people have woke up to that in 2022, where you go from a very low level of interest rates, and all of a sudden now the risk-free rate, or, kind of the 10-year treasury I'm using here, it's not risk-free, it has interest rate risk in it. But it gets repriced like 3%. Well, do I still want to lend to a corporation at 2%? The answer is no, right? And so in that instance, it's like, okay, now 3 is a level I can get with really just locking my money up with the government. So does that tight incremental spread or the credit spread make sense? And so that's what you've seen this year in the financial markets, is that you've had both the credit risk and the interest rate risk really reset in the markets. And so you've had this period of what we call, positive correlation between spreads and interest rates. And this is, there's many cases of this throughout history. It's just over the long term through cycles, they tend to be normally negatively correlated. But in the 90s, in the mid 90s, and you and I are probably a little too young for this, but we're all students of history, right? But in the mid 90s, bonds were horrific in the same kind of components. So that's why a lot of people compare this environment to something like 1994, because there was a big move from the Federal Reserve, and they were trying to, kind of slow down the economy. They were trying to fight some levels of inflation. And so I'd say 2022 rhymes with that period. Now, what you also saw in that period is that, stocks did bad, bonds did bad, 2022, right? And so what it is, it's that resetting of kind of what the equilibrium rate of interest rates should be. So that's the history. That's kind of the textbook and using some anecdotal evidence. But to answer your true question on which one's bigger today, I think we're at the point where they're relatively balanced. And that's because you've seen the FOMC, you've seen the Fed come out and say that at this stage, they're around the neutral rate. The problem is inflation's high. As we're recording this podcast today, right, we got the latest inflation print. It surprised a little bit to the downside. It's not that much to the downside, but the market is really welcoming it, right? Because it's the first time we've had something to celebrate about. We're celebrating an 8.5% year over year rate now, but in March, the 8.5% rate, we hated it, right? So it's funny how markets work that way. The path is what matters. And so as you think about it, the Fed's going to continue to be somewhat aggressive. They're going to continue to hike through this. So the market kind of knows that. It's looking through that. But also, I think the credit component does have some risk today. But the thing about the credit risk is that spreads have widened out to a level across most sectors of the bond market that are commensurate with that risk out there. And so the bond market has been pricing in the higher inflation rate and by extension, potentially a slowdown. There's a lot of talk of recession, in the last couple of months. I think some of that talk is cooled. I know your bears out there will continue to say it. I don't believe we're currently in a recession. I mean, you can't print 500,000 jobs in a month and tell me that the labor market's challenged right now, plus wage growth and those likes. So I think the risks are relatively balanced. So what that means is, as someone who's trying to construct a portfolio, I think you want to own both of those risks, right? I think you want to use them, and you understand that, yeah, if rates move up, let's say another 100 basis points, spreads will come under pressure. But at this level now, you're buying assets to where they have enough yield within them that you can stomach some of that price volatility. So said differently, and one thing that we've talked about a lot at DoubleLine is what you can compare the yield relative to the duration, right? And so it's kind of like a way of thinking about a Sharpe ratio. So if you think about a Sharpe ratio, it's the return divided by the risk. And again, duration doesn't encompass all the risk, but if I think about forward-looking return, yield is one place to start. You can penalize it for defaults and things like that. You can put on your interest rate expectation, but yield is kind of what you get if you hold to maturity and doesn't default. And then you can divide it by the duration. And today in the market, you're finding that there's a better balance of that. And so what I like to say is when yields are high, you can make a lot of price mistakes and you don't see it as much. Do you care if a bond has a bid offer of 20 basis points when it yields 10? Or do you care a lot when it yields 1, right? So there's a big difference in that. And so I think right now the risks are relatively balanced because I think we're in a slowdown. We all know we're in a slowdown. I just don't think the recession risk is imminent right now. And the consumer's been relatively resilient. So from my standpoint, thinking about the asset allocation, we've been a little biased to credit risk as of late, because they got so cheap, right? It got to levels where he said, okay, we've got to start nibbling, we've got to start buying. And if you look at something like a core fixed income strategy that we run, we're going to have about 60% of that portfolio in credit risk, but we're still going to have the other 40% balanced out in some of that interest rate sensitive sectors, things like governments and agency mortgages. So I think right now it's prudent to be, cautious in some of that credit risk, but I want to own both sides of the equation today because I think those risks are relatively balanced. Now, if they're balanced, why isn't it 50-50? It's because of that excess yield component we see out there. Plus, I think the market got too bearish on the recession risk.
Right. Thanks for that. So interest rate risk is the base layer, which is sensitive to the Fed on the short end and on the long end, the 10-year inflation and growth expectations. And then the credit spread is, how much is the market charging Amazon to borrow? How much is it charging ExxonMobil to borrow? Jeffrey, so now they're balanced, interest rate risk and credit risk. Would it be fair to say that the drawdowns in fixed income market that has been very noticeable over the past 7 months, would most of that have been due to interest rate risk rather than credit risk, or is it balance as well?
Well, it's kind of both, unfortunately. And so if you use something like the Bloomberg US aggregate, it's an investment grade only portfolio. So it really has three key components. It has the government securities treasuries. There's some agency debentures in there. Let's call it governments. You have agency mortgages. So think the housing market, the government guaranteed housing market, and investment grade corporate bonds. And if you think about this year, I'm going to call it the tale of two halves. And I'm going to call it the first half of the year had the tale of two halves. The first 3 months was really driven by the duration. It was driven by the interest rate sensitivity, and things like bank loans delivered roughly a flat to positive return in the first quarter. Things like CLOs that are floating rate, things that didn't have duration performed quite well. High yield hung in there. It significantly outperformed investment grade because it had half the duration. Then we got to the second quarter, the fears of the slowdown came in, and all of a sudden credit risk became the problem. And so that's why I say it's a tale of two halves. So is that balanced? Well, yeah, if you look at it throughout the course of the year, yes. But if you're living in the market, it wasn't throughout the course of the year, right? On a forward-looking basis, and again, that's how we have to think. We can't be rear view mirror investors. You have to think about what the opportunity set looks like. And look, if I talk about the treasury market, depending on where you want to buy on the curve, you can get something like, let's call it high twos, 3%. Let's just round it to 3. And if you look at some of the credit markets, especially if you're willing to take some calculated risk, IG is probably about in the high 4s today. You call it mid 4s. You talk about high yield. High yield's really rallied a lot lately. I think high yield's a little ahead of itself. I think it just had this really big flow of money. I think a lot of investors dump money in the ETF market there, and you've seen that from the flow data.
Yes.
But that one, it yields, roughly 7% today. You can go into pockets of, bank loans. You can get 6 to 7%. Emerging market debt, if you're willing to go in the risky sector, the below investment grade, it yields north of 10 today. So there are places to seek opportunity, but you need to be very calculated. I don't think this is a beta market in credit, meaning that I don't think you just naively buy it. And I know I just talked about high yield, and I think that's been a beta trade. Right. But I think you want to own more idiosyncratic things, because I think that the next 4 months are still going to be challenging. The market's celebrating the inflation print today. Oh, Jay's going to be happy. Jay Powell going to be happy. They're going to slow down their hiking path. I'm not convinced of that. And secondly, by the way, next month, they ratchet up the quantitative tightening. So their policy is to tighten. And I think there's one thing that I observed in the last 2 weeks, Jack, that I think is very important for your listeners, is that the market interpreted the FOMC meeting 2 weeks ago as extremely dovish. Right, because Jay said they're near, they're probably around neutral. It's been unusual hikes. We won't be as unusual. We could be, but the market interpreted that as being somewhat dovish. And, you could read it a little bit, but it wasn't that dovish. It was neutral at best. There were some hawkish things there because we'll still fight inflation. Rates rallied pretty significantly over the next 3 days, or including the FOMC day and the rest of that week. All of a sudden, you had the 2-year down like 275, 10's got to like 252. And guess what happened? Fed governors came out of the woodwork. Right? They came out, Mary Daly, who's not usually out there, she's a centrist and somewhat, does very hawkish rhetoric. You had someone like Mester, she came out and she's like, we may have to go above 4. So all of a sudden, what you saw there is that the bond market was flying in the face of the Fed's objective. Remember, the Fed is trying to tighten policy. By the market bidding rates so well and bringing rates down, all of a sudden now you've got an easing of conditions. Spreads are coming in, rates are coming down, and the Fed said, wait a second, this is not what we want. So I think you've got to be very careful on some of these rate rallies. You've got to watch the Fed governors come out and jawbone, and they're jawboning because they want tighter policy. They're still hiking rates. That's a tightening of policy. They're going to ratchet up the QE next month. That's a tighter policy, and which that means there should be more volatility. Yeah, QT is quantitative tightening. Yeah, and so we've started that. They're due $45 billion, or they're targeting $45 billion a month right now of unwind of the balance sheet, and it goes to 90. I'm sorry, it's 47.5. It goes to 95 billion starting next month. So things don't get easier in the financial markets. And so I think we're just in a choppy environment until inflation gets contained. I think we're somewhat rage bound, but I think the front of the curve is a little dangerous. Now, people got excited about, I can buy 1-year T-bills at 320. This looks great. But also, I think the Fed gets there pretty quickly. And the market price is in kind of the by early next year, we're at 3.5 on Fed funds rate. So, does that sound like a great trade? Well, it's not bad. Inflation's probably going to curtail itself in the next couple of years. But so a 2-year treasury at 320, yeah, you can see that. But there's also risk to that, because if the Fed pushes higher, the 2-year probably needs to be closer to 4% than the low 3s it's at today. So I just think that we're not out of the woods on that. But also, so you take that, then you say, okay, what does that imply about 10s? Well, historically, the 2s 10 spread when it inverts, if you look at kind of some of the recessions, like in the tech crisis in the 2000s, 2s 10s got to about minus 50. I think it's minus -52 or something. We got close to that yesterday. We're at -40 today. But I think that's roughly where we go. It's -50. So that means it brings the whole curve with it. Maybe because of the inflation fighting, the market thinks it's more transitory. And ultimately, maybe it goes to 70. But, if we're talking 375, that still says the 10-year should be north of 3. So we'll have to see. That's why I like to have a balanced portfolio right now. But also with some of this risk rally, we're kind of fading a little bit of it and kind of getting rid of a little bit of that credit risk at the margin.
Jeffrey, there's this perception out there in the market that the stock market, that's a bunch of speculators. Apple goes from 140 to 150. All these stocks go up and down for no rhyme or reason. But the bond market, that is a sanctuary for scholars. And the bond market is a truth. The bond market can snuff out future economic conditions so that, with the yield curve inverts, that's a sign that a recession is on the horizon. And the track record is actually quite good. How much faith or how much credence do you give the bond market? When the yield curve is inverted, is that surely something you pay attention to, but is it something that you say, oh, the bond market is telling me something, or do you just view it as there's buyers and there's sellers and this is what the price is?
Yeah, well, it's always the latter, buyers and sellers, and that's the price. And I like that you think we're a bunch of scholars in the bond market. So I'll tell my mom about that. She'll be very happy that I work with a bunch of scholars. But ultimately, it's a forecasting mechanism, you say. And you kind of point out the Eurodollar futures curve and, the path of interest rates. And if you look at the forecasting error of the bond market on the path of interest rates via both the Fed as well as forecasting exactly where the 10-year is or anything, it's pretty poor. It's about as good as forecasting earnings in the stock market. So guess what? It all boils down to we're human. We're trying to make a sense of a very noisy economic system. It's a multivariate universe. They want to distill down to a univariate kind of analysis. And so I think, when I think about what the bond market's telling us today, the inverted curve says that there's economic trouble on the horizon. You never dismiss it. Never dismiss it. Doesn't mean that it's imminent. And what a lot of people miss in this is that usually when the recession starts, the yield curve is steepening, right? So that's contrary to what we just talked about. The inversion of the curve signals a recession. But by the time we get to the recession, the curve is steepening. Why? It's forward looking. Just like stocks bottom in the, early in the recession, they don't bottom at the end of the recession typically. And again, it's a forward looking mechanism. So my concern today is not that the 2s10s is inverted. I think it's inverted for a good reason. It's inverted because the Fed is going to go above neutral. And the bond market is nervous that going above neutral and fighting this inflation is going to slow economic growth. And therefore, you have that kind of recession risk somewhat priced in. So I think at this level, the key you want to look for is the steepening of the curve. When 2s10s goes positive again, that's not a good sign. Historically, that's the bad sign where you're mired in the recession. And so again, I think the forecasting mechanism of the bond market's similar to any other thing. It's very difficult to do, but, it is driven by macroeconomic data. So the way I think about kind of what I'll call the 3 core markets of investing, right? Stocks, bonds, commodities. I like to think of stocks as the forward-looking mechanism, right? I think of bonds as kind of the contemporaneous. You want to know where the economy is, look at the 10-year. Right, that's the old adage, right? That it should trade on kind of forward look, kind of where we are on nominal GDP in general. I know nominal GDP is significantly higher than the 10-year, but that's it's a contemporaneous market. And commodities are backward looking, right? That's where the inflation started. So I kind of think of those 3 time horizons across those markets. But in general, I don't think the bond market's any better than the others. But I do take credence in you calling me a scholar since we work in that.
Yeah, well, you are a scholar, Jeffrey. So the bond market steepens once you're actually in a recession, and most of the time, correct me if I'm wrong, that is a bull steepener. That is, short-term rates are collapsing because the market is pricing in the Fed cutting drastically. But if the Fed does not cut drastically, that won't happen. And also, you're absolutely right that the 210 yield curve inversion is extremely forward-looking, something like 12, 18 months. So if the yield curve inversion if the 210 inversion, if 210 spread entered inversion earlier this year, that did not mean that we were in a recession in April of 2022. It meant maybe there will be a recession in April 2023 or later.
Right. And also you got to think about the environment. And so in this environment, we're talking about inflation fighting. The Fed said they're going to have to go above neutral. Will they recant, or will the other part of the market catch up to it? And that's to be seen. It's how well can the economy stomach these higher rates? And so, corporate America did a phenomenal job in 2020 and early 21 of refinancing the balance sheets, right? So you now have this term financing, it's longer out. And so even if we are, or let's say we tip into a recession in 23, I don't think the default cycle is going to be deep. Right? Because again, you don't have these big maturity walls. There's all this refinancing activity that has to be done at the same time. And by the way, it doesn't have to be done in 2023. So, maybe with higher rates, we take out some of these zombie companies, things that shouldn't have survived and survived significantly on low rates. But also, a lot of people forget that, the Fed has engineered soft landings in the past. And I'll actually say the last hiking cycle was kind of a soft landing. Right. If you think about it, they hiked all the way going into 2018. They started to cut in 2019 because they saw signs of things slowing down. Also, they stopped their quantitative tightening because they were really destroying some markets with that. They were really sucking liquidity out of the system. And so they were really able to engineer that. Now, you can say, well, we did have a recession, but it was also a pandemic-driven recession. So maybe we would have had the recession, and the Fed would have had, this track record that it tends to be biased to them having hard landings and putting us in there. But really, if the Fed is calculated with this, and again, if rates are 350, that's where the market's pricing, as you said, for January or February of next year, they've got 350 to cut. Right. So you can do it quite quickly if they've seen signs of cracking. So will they do that? Inflation has to come down. Right. I don't think that they start cutting rates unless the inflationary environment changes in a meaningful manner. And we do think it comes down. The bond market thinks it comes down. So if that's the case, maybe the price in the Eurodollar curve is right. Or maybe we can just keep those rates at that level for a time being, let the economy work things through, and you'll get the steepening of the curve, but it doesn't give you the recession. So again, it's always dangerous to say this time is different, but there are a unique set of factors here. And my bigger concern would be that ultimately they continue to do quantitative tightening. They suck too much liquidity out of the system, and that causes challenges for the global economy. So as I said, we like to distill it down to one variable, twos, tens tell us this, but it is a multivariate universe.
And do you assess liquidity conditions? Maybe you can go back during quantitative easing in 2020 and 2021 when it was noted that liquidity was ample and deals could get done. Spreads, bid-ask spreads were narrow. Every now and then I buy stocks, but I don't really trade bonds, so I don't know. Apple bid 140 and ask 140 and 1 penny. But in the much more illiquid fixed income universe, that's where liquidity and particularly quantitative easing comes into play. Describe the conditions of the ample liquidity over the past 2 years, and to what degree are you seeing liquidity come away from the market, bid-ask spreads widening, or do you have another metric that you measure liquidity by? And to what degree do you attribute that to the Fed rate hikes, QT?
Yep. Yeah, no, it's good to make the distinction on a penny wide on a common stock versus a bond, because no bonds trade a penny wide, even treasuries. And so I'll take you through a little history of liquidity over the last couple of years. And we have traders and portfolio managers that have been doing this since the 80s, right? And so that's the 87 crash. I mean, they have a lot of the 94 experience. They have a lot of experience of watching markets. And the liquidity in March of 2020 was the worst in any of our team's careers. And that goes for Jeffrey Gunlock. That goes for everybody on the team. Folks, we had one guy that actually was running money back in the late 70s. And so what you see in that market is it froze up massively. Treasuries, which typically trade, like we call it a tick wide, that's the trading block of it. And they usually trade about a tick wide or 132nd, 164th, depending on market. So they're very tight in general. And what you found is things that were off the run securities wouldn't even trade. So you're talking about the 9.5-year treasury won't trade because no one wants to trade it. And if it did, it was 4 points wide. Right. So you're talking pennies in the market. We're talking about percentages on what's perceived to be the most liquid part of the market. So there was a problem. There was a massive problem in the market. Some of this has to do with regulation. Some of this has to do with dealer balance sheets, dealers not wanting to take risks. It also has to do with everybody on one side of trade. Everybody was selling anything you can. Sell your house, sell your kids, sell whatever you can sell. We got to raise some money right now. And so that was a very dire situation. There's a reason the Fed cut quickly. They stepped in. Now, the way they did it, we can argue the legalities of it. Should they have bought corporate bonds? I mean, investors now think that the Fed, the next time there's a problem, they're going to buy corporate bonds. We hear that from institutional investors. We have a client that told us that, well, why should I buy this other stuff? The Fed's just going to support this. And this is like last week they said that. So why I point that out is that liquidity conditions have changed over time. The less propensity to risk, some of it's regulation out there, and dealers never have stepped in crisis. So that's kind of a bad example. But you mentioned the ample liquidity, flooding the market with newfound cash, buying securities, driving rates down. The spending spree that the fiscal authorities did, and look, they gave it to corporate America. We all harp on the inflation coming through, the consumer, and the free money, no one wants to work. There's those old sayings there, but we sent it through corporate America. That's where the handouts really were, and it supported the system. Now, liquidity conditions have dried up again. They're not 2020 levels. Liquidity has been pretty poor this year, but that's what happens in a one direction market, especially when it's selling. And so what I've witnessed in the market this year is that you have fixed income selling, you have equity selling. There's not a lot of buying, right? There hasn't been. I mean, now in this last rally, you've seen some flows come back a little bit. And so it's like, well, where's the money going? Is it going to cash? I think it's going to spending. I think people are doing the revenge travel. You hear about, they're going out and spending money and they're saying, look, I've been cooped up for a couple of years. So that's not tenable in the long run, but that's actually what's supporting our economy right now. So why did I bring that up? Well, I think that liquidity has been somewhat poor because it's a one direction market. And when it's a one direction market, no one wants to be on the other side of that. Right. And so you need two-way flow for liquidity to come back. And, when we talk about liquidity, I'm also talking about financial conditions. And so the bid offer spread was wider probably than comparing today to, let's say, 2 months ago. Bid offer was significantly wider a couple months ago because, again, you're seeing two-way flow into the market. But again, if we're talking about a bond, if it's half a point wide and it has an $80 price, who cares? Right? The yield to maturity on a 5-year bond, if it's a half a point, it's 10 bips. Like, it doesn't really matter. Right. And over a period of time. So ultimately, I think that the liquidity isn't there because the money isn't there. Right. And then you have the Fed's going to tighten on the other side about, essentially putting more supply of securities into the marketplace. So that just creates competition. Right. So if the Fed is, and the Fed's not really selling securities, right? They roll off the balance sheet, their treasuries, they roll off, right? So they mature, which means the government has to refinance them because we don't have any money, right? We borrow money. So to pay down the treasury, we issue a new security, but the Fed doesn't buy it. So that's new supply into the marketplace. So supply and demand remains constant, supply should push the price down, should push yields up. So I think part of that is liquidity, is that there's uncertainty, and that leads to these kind of bouts of illiquidity in the marketplace. And so nothing compares to 2020, but you're starting to see a little more two-way flow in the market because you've seen some stabilization in rates. You've seen stabilization in spreads. And usually you don't see a bottom until you get what we call a washout event. Usually you have a fund blow up, or, I thought maybe some of these crypto cracks were some of those events, but it didn't seem to have a lot of pain in the marketplace. Usually markets bottom in a recession area at max pain. Think the Lehman events, think about how that trickled over. And so you haven't really seen that. So although this has been an ugly market, it's been somewhat orderly. Right. But you couldn't do size, even if you wanted to buy it. You couldn't go out and buy, 50 million blocks of bonds in most markets because it just wasn't there. And also, no one wanted to sell it to you. Right. We're all saying, well, we like the yield. I don't want to go out and sell it. And we're forced to sell sometimes under that condition. And so I think thematically, you've seen fixed income managers also carry cash this year because, again, we've all had redemptions. We all kind of think rates are kind of moving around. We think spreads need to move around. And so I think you're starting to see more balance in there. And so, again, we're seeing investors come back. Institutional investors are trying to, meet their targets more now with fixed income. And so in general, I think liquidity is okay. But again, high yield bonds never trade a penny wide. They never will. It's just one of those markets. So I guess never's a dangerous thing to say. But so I'm worried about the Fed's liquidity impacting rates, and that's trickling over in the other area. And we saw that the last time. And it's dollars getting shortage in the marketplace, right? That's what QT ultimately is. We flood the market with dollars in QE, and then it pulls back. And so that pulling back is the access really to the dollar trade.
So that shortage of dollars, the pulling back of liquidity, that reduces the supply of dollars. But what about the supply of assets? How many corporations are coming to market trying to issue a high yield note, an investment grade note? I know that in December 2018, I've heard that what really caused the Powell pivot was the high yield bond market was frozen, not necessarily on the secondary market, but on issuing new paper. What does the
days,
sort
I
of
think, was the
new
number.
issue market look like?
Yeah, I think 47 days was the number during that period. And I'm still not convinced that's why the Powell pivot existed. See, when Jay Powell was promoted to be the Fed chairman, he was lauded for his attention to credit markets. He's a credit guy. That's what you hear. He looks at spreads. He talks to, the corporate leaders. And so he should have saw those signs earlier. Right. So the idea that he said the balance sheet's on automatic pilot, damn the torpedoes, full speed ahead, with this policy, I think it actually took him meeting with Bernanke and Yellen, the first week of January. I think that's where the pivot took place. I'm not convinced it was actually the bond market because those signs were there. The high yield market froze a few weeks ago. Right. And again, that's kind of where the lows were again. Right. There's no issuance. This happens when you get big moves in rates or just borrowing costs. Right. It can be rate driven or spread driven. So we saw that. Good news is, Jack, the high yield market's open on new issue again. Right. And so you're going to go through these periods. Some of them are seasonal. There's other pockets like securitized credit where, just deals get done at certain times of the year as well. So I do credit Jay Powell for navigating this environment. He gets a lot of criticism. We've been Fed critics. I think he's done a good job this year. I mean, think about it. When Yellen first raised rates back in 2016, right? And then we got to the end of that hiking cycle, they got to roughly where we are today. And it took them almost 4 years. It took them, 3 years to get there. We did that in like 4 months. 5 months, right? From the hiking cycle, from May to now, it's like 5 months. So, I mean, give the man some credit. I mean, he had the fortitude to push forward with this, and we've gotten to around neutral much quicker than we did in other cycles. So I think he deserves credit. He's learned how to talk at the press conference. One of these things, you got to learn on the fly of the job. I couldn't be the Fed chairman. I'm going to say something stupid up there too, right? So, it's that thing. And people don't parse my words. Everything that man said is overly scrutinized, right? So I think he's learned on the job. He's doing a good job. Look, they're in uncharted territory. He did a mea culpa as well. I think that's what the market liked as well. He did that mea culpa and say, ultimately, we were wrong on inflation. The humility is important here, right? Because we've seen the hubris of the bankers saying they can do this for the last 12 years, that we're masters of the universe. We know the best. And I think that there's a lot to be said about that. So as you look at, the policies, it's not just, the interest rate policy. We rely heavily on forward guidance today. And Jay pulling that back, to me, saying there is no forward guidance, the market celebrated because it's like, okay, we're not on a set path. That's good. But also they removed the forward guidance. They're not exactly telling you what they're going to do, right? So there should be a little more volatility in the market. And that's also warrants, when there's volatility, it's higher bid offer spread too, to bring back to the last question.
Right. And do you, are you, I know that they were doing forward guidance that was very apparent, that was influencing forward rates, and that was allowing the Federal Reserve to tighten monetary policy much more than just pulling the lever of Fed funds rate, because you can't, pull Fed funds up 200 basis points in a single meeting.
But
now they're saying that they're
other
not doing
banks do it,
forward
Jack,
guidance.
Jack. Other banks do it. They're just called emerging markets, but other banks do it.
Fair.
Yeah.
Fair. An excellent point. The Fed does not do that. So they're saying they're not doing forward guidance, and yet the consensus about where the Fed funds rate is going to be in December remains, pretty centered around that 3.3, 3.5 basis points. So is there sort of soft forward guidance where they're saying they're not doing forward guidance, but it's not as if, people are betting that they're going to cut rates to zero by December, right?
Yeah, no, that's a fair point. I think soft forward guidance. I haven't heard that phrase, so I'll credit you if I pilfer that phrase. But I think it is kind of soft forward guidance. I think you're right there. But you said I'm going to jump back to that. They don't hike 200 basis points, and we had we had our investment team meeting, and I'm talking to all the heads of the various areas. And we're talking about Fed policy. This was in March, and they went the whopping 25 basis points. And our Treasury portfolio manager, who's been doing this for almost 40 years now, he said, "Man, 25." And then we got the 50, and he was like, "Man, Greenspan would have just done 100 intra meeting," and he freaked out our younger staff, right? Younger staff being people in their 30s and 40s, right? Like, what do you mean? They don't remember that kind of stuff, right? And the Fed used to just hike. There was no such thing. You would sit on a trading desk. Again, this is before my day, but you'd sit on a trading desk. There's a squawk box. It's like the Federal Reserve just moved interest rates up 75 basis points. Everybody's like, what? What just happened? It just comes out of some speaker, right? So we have set, because our dependence on the central banks over the last probably 3 decades, we got used to it, and we've edged into this direction. And I think really why forward guidance became important was that I credit Mario Draghi for this back, I think it was in 2014, where he said, we're going to do whatever it takes. And he did nothing. But he said, we're going to do whatever it takes. And that brought confidence into the market. The Fed, in that case, the ECB has our back. And right now, I don't think the Fed has your back. The Fed telling you they want to fight inflation. They're going to slow things down. They're going to tighten financial conditions. And they don't care if you go into recession. So that's why, people question the Fed put. Where is it at these days? And I think the Fed would definitely pivot if the S&P broke 3,500, right? There's just a pain level. There's a pain threshold where corporate America, the CEOs are going to go complain, right? And that's what actually helps form policy as well. Don't forget, Jay Powell does not make these decisions in a vacuum. He samples, he surveys, he has dinner with all these people. He figures out what's going on in the economy. And so I think forward guidance is a good thing. And, again, they're going to be data dependent. But guess what? At the next Fed meeting, if the SEPs, this statement of economic projections, comes out, and all of a sudden they have a 2023 rate of 4.25 is the kind of median rate, you think the bond market's going to not puke that day? It's absolutely going to. So that's why I'm a little cautious on this next Fed meeting too, because I hear 4. I keep hearing 4 from a lot of people. A lot of Fed governors are talking about 4, and you're telling me the market's pricing 3.5. Seems that the market's a little too optimistic on the pivot. And again, the economic data has been strong. Yes, GDP was weak. Consumption inside of there was positive, and people will rail me for that. Well, the rest of it was negative. Doesn't matter. This is a big economy. The jobs market has been strong. Household survey, the established report, very strong jobs numbers. Wage growth is there. The job composition was higher end wages. It's hard to really say that we can't take this interest rate level. Now, the bad news, Jack, is that monetary policy operates with the lag. So these hikes that we've seen aren't necessarily in the economy completely yet. But, at some point, you're going to pull, you mentioned asset prices. Well, people will also say, you know what? Why do I need to take risk when my money market pays me 3.5? Right? That's also the plan of the Fed, right? Pull money away from that, make people save money and less speculation. So I think that it's still going to be a challenge the rest of the year. I don't think we're out of the woods yet. And I just think that, there's going to be some trading opportunities out there in the marketplace. And you're seeing that. You're seeing emerging market debt still trading significantly wide relative to other markets. High yield has narrowed in pretty significantly. But some of the commercial mortgage market, some of the residential mortgage market, they're still pretty wide. But also, I think because we're in a lower liquidity environment with QT coming, I think spreads should be wider. So, that's what we're cautioning our folks internally. It's like, okay, these are the widest we've seen in a while, but should they be? And the answer is probably yes. So don't get too excited, but also we got to spend some of this money we have. And so there's very ways of doing that calculated risk today.
Jeffrey, so you say we have to spend some of that money you have, and that's a great point because, individual investors, perhaps they're watching this podcast, they get bullish on high yield, they can buy high yield ETF, they want to sell it, they can sell it. They can short it. They can get an ETF for mortgage-backed securities, liquid. Pick your poison. They can do whatever they want, and also they can just have $0 in assets and 100% be 100% in cash and not really pay a penalty for it. Jeffrey, I can't think of an institution that is the more opposite of that than your firm, DoubleLine, which has an enormous amount of assets. You can't just hold everything in cash, right? You have to put money to work. And
I wish we would have now, right? We'd have been much better off, right? But clients don't pay you for that. We're risk takers, right? At the end of the day, we're paid to take that risk, and so you either like it or you don't. And if you don't like it, sell it. It's the same thing you said with all of that stuff. And so our job is to try to invest through a cycle. And look, we've carried elevated levels of cash, but not enough, right? The cash has been the best performing asset in the fixed income market year to date. So it is a challenge. What I think is now the market is a very good opportunity. And so I think you're going to see some cash come back to fixed income markets, which you mentioned. That's where the flow's been. And so someone asked me recently, isn't the market neurotic? They're buying long duration treasuries and they're buying corporate, junk bonds, right? And I said, it's not a bad trade. You're betting on the economy and you're betting against the economy at the same time. And they're both positive carry, right? I earn on the long bond, I earn on this side. Yeah. But also the long bond can go down 20%, right? It did this year, right? So that's the risk to that. But, own some. And so you have to put it all together.
So when you said 20%, down in the long bond, that's obviously not the 20% rate. That's the price is down 20%. I think on TLT or some of those zero coupon ETFs, I think it's more like 35% max drawdown. Obviously now it's rallied significantly. Yeah. What is your, let's say, 95% confidence level for the 30-year Treasury bond, which has sold off tremendously, rallied over the past month? Would obviously a 6% 30-year Treasury would surprise you, but 5%, a 4.5%.
It's okay. Next 12 months, my 95% confidence interval is between 1 and 4. And I said 1% and 4% because I think it could be that wild, right? And so then you say, well, that's not even a forecast. I agree with you. It's not. I don't think it goes above 4, but if the world collapses, if the U.S. economy collapses, we could go test that 1% level again. So now, give me that range. I think the probability is very low we get to 1, but you want a 95% confidence. That's what I got to get to. But I think, the long bond probably should trade a little bit higher than it is today. There's been a lot of buying of it because it's perceived to be the risk-off asset. I mean, price higher. So yield lower is what I'm talking about in the risk-off environment. Yeah, I may have said that wrong. Price higher, yield lower. You can make money on it. If the long bond goes down, yields go down to 2% from the 3% level today. With the duration on that asset, you should make north of 20%. That's a very attractive return. I think people will call that equity-like returns, right? So when we put together the portfolios that we've been doing, and we get the credit we want, we look at the interest rate exposure we want, but we want to have a little bit more duration in the portfolio. We've actually been buying the long bond this year, right? Because it has that chance of the risk off. So I said we have this kind of 60% in credit, 40% more rate sensitive, but that rate sensitivity is kind of longer duration. So my key rate duration is longer, to speak wonky like a bond nerd, but it also has more bang for the buck if something happens. So, when you look at the asset allocation at times, people don't understand that sometimes, you'll have severe credit risk. So if I have significant credit risk, the way to offset that is that kind of long bond, or, if you do it yourself, it's the TLT. So to me, the TLT HYG trade makes sense. Because it's like I'm betting both kind of ways and spreads are good, but how do I offset that? Now, maybe it shouldn't be 50-50, right? You want to manage how much key rate duration you have. So I'm not against the long bond at this point. In fact, as I said, we've kind of used that to lengthen the portfolio. So even though our duration short in the market, we probably own a little more key rate duration longer, because I think the front of the curve is dangerous still. I think the market could be mispricing the Fed's behavior, and we've seen the volatility now. Look at the 2-year Treasury. It was like 275, 2 weeks ago, or like a week and a half ago, and now we got to 320 yesterday. It's rallied to 310. It's volatile. And again, the duration's not long. It has about a 1.9 year duration. Maybe it's 1.85. So you're not going to get really killed on those rate moves, but also that's the Fed policy. And so the back end has kind of been a lot more stable. And so again, probably the real range is probably between 2 and 3.5. I'll tighten that in a little bit, on the 95% confidence interval. But I think if we hit a recession, I think you're going to see the long bond get close to 2%.
So you see the risk that the long bond continues to sell off as a relatively remote possibility to 4.5%, 5% because of inflation.
No, I don't think it pushes up to 4.5, 5. I think if it does, it's going to take a couple of years. I think it's that we got through this hiking cycle. The inflation's a bit more persistent. We live in a 3.5, 4% inflation world. If we do that for a long enough period of time, the long bond will reset. Right. It trades more nominal GDP over the long term. So, again, I think that it would take a period of time. That's why in a 12-month period, I think it has to be condensed somewhat, because I just, the bond market doesn't believe that this inflation rate is sustainable, which I agree with. But I also think we're going into a higher inflation era. We lived in a world of 2. I think the 3 is the new 2 for inflation. And we'll have to suss this out, over time. But I think you've seen wage growth. Labor's had a very powerful hand in this cycle, right? Think about you're recording, your podcast from where it is. We do this remote. It's a hybrid world. Sometimes we're in the office, sometimes we're not. And so labor has an upper hand. If you want to hire people today in finance, unless you're sitting in Midtown Manhattan or downtown or Midtown Manhattan, there's a lot of flexibility in that. If you want to hire someone, they want flexibility. Labor has the upper hand. And typically when labor hasn't had the upper hand for a while, right? Capital's had the upper hand. It's just that push-pull of labor and capital. And so the big question is, when the next recession comes, does labor still have the power? And we'll have to see. But given the employment situation, I think labor still has power, which means we still have wage pressure, which means we probably have a higher inflation rate than really what the bond market is signaling right now. And so, again, I think that means that back end could move up. But again, there's the recession risk. So that pulls yields back down. That's why it's a push and pull. Growth pulls rates down, right? Because it's going to be slower. And then inflation pushes rates back up. And that's why I think you're seeing kind of, people call it the neuroses of the market, but I think there's a lot of credence to what's happening there.
Jeffrey, a lot of the assets that DoubleLine is interested in is in the mortgage market that's both guaranteed by Fannie Mae as well as the non-agency, not guaranteed. What's your outlook on the mortgage-backed market, and what are also the risks and opportunities? Like, what would have to happen for those investments to go very well? What would they have to do for you to experience losses?
Yeah. Well, the agency financing is still the bulk of the financing for the mortgage market in America. So for all the criticism that Congress gives the Fed about buying agency mortgages on their balance sheet, they didn't buy agency mortgages in this cycle to support the housing market. They bought agency mortgages because they didn't want to own so much of the treasury market, right? They have a high $7 trillion balance sheet, right? If you bought that, that's roughly, 35% of the outstanding of the treasury market. So what they were trying to do was buy interest rate sensitive assets. And, the Ginnie Maes are explicitly guaranteed, and the Fannie and the Freddies have the quasi. So they were trying to stay within that mandate and manage the interest rate component. And so they've always done it at a 2-to-1 ratio, always being, QE and QE2, QE3, and what the last round we did. So the idea that they've supported the housing market, I think, is a fallacy. Now, back in 2008, they did support the housing market by doing so because it was broken, right? There was no lending in the private markets. No one wanted to underwrite credit. So they needed to get some sense in there. So they were buying these quasi-government guaranteed and government guaranteed assets to essentially drive down rates in general, right? They weren't out there saying, we want house prices up. Right. And that's what you'll hear out of Congress. Like, you created this housing bubble. Now, there is some truth to it because some of the housing strength is because of low interest rates. But I don't believe it's because they owned agency mortgages. So the system is still heavily financed by the agency side. So, again, what that means is that it just goes through those government entities. Now, when you think about the risk there, really the risk you have in today's market, if you buy securities that trade at a discount, there's not a lot of risk there. And why I say at a discount? Because if you buy bonds at a premium, they prepay too much, you get paid back at par, that can hurt your return. But now you have coupon, you have carry. A lot of these securities will trade at a discount, right? So prepays are good. You buy something at 95, all your amortization comes in at 100. That's a good thing. And so they're on a hold to maturity basis. They don't have a lot of risk. They have interest rate sensitivity. Yes, the prepayment speeds can move back and forth. So the agency market, what happened is that this year, the agency market got pretty cheap. It was extremely rich 1 year ago. And we got to our lowest weight in agency mortgages that we had because it was rich because banks were flush with cash. When I say banks, think the investment banks, and they need to buy high quality assets. They were flooding the mortgage markets that spread relative to treasuries. The spreads, the option adjusted spread got let's call it 30 basis points. And that's historically very tight. Today, that same OAS, the option adjusted spread, is like 150. Why is it so high if it's a government guaranteed asset? There was the perception in the marketplace, at the beginning of this year, and a lot of strategists talked about it, that the Fed was going to sell mortgages. So if you sell mortgages, again, supply demand, right, it should drive the yields higher. And so what you've seen in that market is that spreads are pretty wide today. The problem that we have is that they're interest rate sensitive. So do you want to add duration today? And when we see in these spreads, we like the spread, we think they're attractive, but we want a little higher yield environment to get into. So there's something very beautiful about that market today, the way it's set up, that it's hard to, mark to market, you can lose money, but, again, it's money good, we think, over the cycle. Now, again, people don't stick with you the whole cycle, so you got to manage the mark to market, as we all know. The non-agency side, on the other hand.
Right, and just a question. Sorry, just on the interest rate sensitive. So a treasury, 10-year treasury, the interest rate sensitivity is pretty simple. If interest rates rise, the 10-year treasury price will go down. If interest rates fall, the 10-year treasury price will go up. However, it's a little more complicated with mortgages, right? Because explain that. If interest rates go up, refinancing people don't refinance, so it's complicated. As you can tell, I don't get it.
It's very complicated, and as you just said, people don't refinance. That's not true. Some people do refinance. Some people have a life event. They need some cash. They're going to refinance. The house is worth a lot more. You can cash out a little bit sometimes. Also, people move. Right. There's also what we call the 3 Ds of the housing market. There's death, destruction, and divorce. Right. They cause you to sell an asset. Right. And so you sell the asset, you pay off the mortgage. Right. So that's a prepayment. So it is complicated. But at the end of it, you can just think of it as like it's an interest rate sensitive asset. You've got to manage what we call the convexity of it. Just that's how those prepayments move up and down. And, a lot of those mortgages are out of the money. They're not going to just be naturally refied because people save money. You're going to need the 3 Ds to kind of kick in, plus attrition. There's also the migration of the housing market. That is one thing that people forget about. As long as the job market is robust, people move. They change locales. They leave my home state of California and they go to Texas, they go to Florida. They pay off their mortgage, they buy a new one. So that is a prepayment as well. And then some people, they just say, hey, I don't want to have this debt. I'm going to make an extra payment on my mortgage, right? So there's always some level of prepayments. They historically have never went to zero. And so again, it's complicated, but it's one of those markets that you can, if you know how to analyze it, you know how to look through it, you know how to pair it with different types of securities in there, you can do pretty well through a cycle and you can outperform the treasury market. But you mentioned the non-agency market, and that's an interesting market because right now the non-agency market is, and these are not guaranteed. So the bondholder takes the default risk. But if you look at that market today, and let's say originations, or let's say securitizations that have come out in the last few months, those loans were seasoned 6, 9, 12 months before you put them in a securitization pool. What's happened in housing in the last 6, 9, 12 months? I think prices are up a little bit, right? If you look at the Case-Shiller data, it tells you 20%. So you have this embedded kind of gain in there that you can take prices resetting down and it's okay. The other thing is that if you buy, there's structures And so you don't have to be exposed to the whole thing. You can be buying senior tranches, AAA rated stuff that is really AAA today, right? The underwriting's good on the mortgages, there's documentation, and someone else supports that structure and the loss. And those securities today, AAA loans, some of them yield like 5.5%. Today they're probably about closer to 5 after this rally we've seen. These securities, by the way, back in December got to 2%. We took a buyer strike. We said we're not buying anything sub 2.8 we don't like. I think someone tried to do a deal at like 1 and 7/8. I don't know if that cleared or not, but that was absolutely the low there. But look, there's strength in it. The securities, most of them will get refied in 2 to 3 years, and so they're not long life either. But when the problem, Jack, is that it's keyed off the 2-year part of the curve. So that's been the volatile part of the curve. That's what repriced. And so these mortgages, the reason they've widened out like that is because it's the 2-year treasury that's driven a lot of that. And then again, that whole idea that spreads were too tight, they need to widen out. So they're very attractive today. But also, you don't have to just bet on housing. You can sprinkle this with some asset backs, things like, consumer loans, franchise loans. You can even go into infrastructure related product, energy. So there's all these different things in the securitized world that do have a complexity premium. You have to understand structure. You have to understand credit underwriting. But when you start to look at this, you don't just have to make this beta trade. So our credit risk today, we own very little EMD. We own some emerging market debt. We own a little bit of high yield. Okay. We've been selling that down a little bit. We own some bank loans. We've been selling that a little bit, just kind of at the margin, right? We own investment grade corporate bonds. We own more than we've owned previously. But also, we have exposure to the commercial real estate market. We have exposure to the residential mortgage market. We have exposure to the CLO market. And we also have exposure to these ABS structures. So when I think about my credit book across these products, right, our portfolio managers we are spreading our credit exposure around. And that's what you're supposed to do in markets where there's not massive dislocations. Now, I think there's a dislocation in EMD today, emerging market debt. However, I think it's warranted, right? I think the liquidity can be a problem as we go into the year. I think there's global macro risk, there's China risk, right? So that's why we haven't stepped back into that trade at this point. And look, in some of the stuff in our riskier products where we've owned it, it's like, look, the underwriting, look, these bonds now yield 20. So even if they default, not all of them are going to default. If half of them default and we get zero recovery, which usually gets something, it's still a 10 return. It's kind of hard to lose there, right? So you've already wrote it down in some of those instances. So, let's just kind of see that. Now, do you want to add here? Probably not. You want to be more calculated in because you want to try to get that 10 that you can get the 10, right? And so I think as you think about the credit markets, we love to have more diverse credit exposures. Now, credit's credit. When it widens, it widens. But if I can get different bets in different parts of the economy, I just don't have this myopic narrow trade. And so that's what we're thinking about today.
So you said that you were underweight on bank loans. You're starting to sell off bank loans. I think that you did have a lot of bank loans, and bank loans are not unique, but they're special in that they have no interest rate risk, right? It's SOFR +2, LIBOR +3, right? Or not always.
Well, they typically are floating rate, as you're pointing out. They have interest rate risk, but it's usually very short, right? Because they reset quarterly. And so most people think of them as having a quarter of a year duration, which in the grand scheme of things, what we're talking about is benign interest rate risk. They have spread risk. Right? They have spread duration, as we call it. So even though they have no interest rate duration, they have spread duration. And that's, if spreads go out 200 basis points, it's a 5-year kind of deal, you're gonna lose, a duration of like 5 times the spread there too. So that's how you can be down 10% in bank loans, is that spread reprices as well. But the other thing about bank loans is, remember, in a rising rate environment, they're great for investors, but the company itself has to pay that loan at a higher rate. So now you've got to think about margin compression. You got to think about who has pricing power in that space. We know that there's labor and wage pressure. We know costs. You've seen the employment cost index. Benefits are costing more. So if you think about that, you want to identify companies that can withstand that. So again, we're not investing in equities where that margin is the most important thing, but you want to have a margin of safety, right? Can they withstand the storm? What can they do? What does the facility look like? What other assets do they have? And they tend to be senior in the capital structure. So, this is a part of the market that people loved because of the rising rate environment, but also when the economy looked like it was slowing significantly and there was a recession risk, they pulled back.
Jeff, thank you so much for coming on. It's been an absolute pleasure. You are on my podcast, Forward Guidance, but you have your own podcast, The Sherman Show, which you had a lot of really interesting interviews with fascinating guests. And I'm actually a little bit, I have podcast jealousy, Jeffrey, because you recently interviewed Zoltan Pozar, who I've been trying to get on my podcast for a while. So I definitely recommend folks check that out.
Yeah, I guess the advantage I have a big firm, and we have a lot of relationships across firms. And so, the way we got Zoltan, it wasn't that I emailed him; it's that we used our bond traders and their sales guys that we know. I have a little bit of advantage to you there, Jack, but I like the work you're doing. That's why I came on your show. So keep up the great work, and over time you're going to get some of those great guests too. And this may be a low point in your podcast cycle of having me on. So I appreciate the time you spent with me today.
No. This is a high point. This is a high point, Jeffrey. You are a real expert in fixed income, and there are a lot of people who they can sort of talk the talk for like 4 or 5 minutes about macro, but people who really know the bond math and know it cold and are managing lots and lots of money. Those people are hard to get, and so I'm really glad that I got the chance to talk to you.
Thanks. It's a pleasure. And yeah, I guess it's been an hour now. So hopefully we still have people listening after all that wonky bond talk. So thanks again, Jack. I really enjoyed it, and good luck to you guys.
Cheers.